Hi, I'm Steve LaFrance with Blakely Financial, and I'm presenting last month's recap. The S&P was down 2.5% in February, giving back a portion of its January gains, but still up 3.6% year-to-date. Similarly, bonds were down for the month, but remain positive for the year. And this can be explained simply as good news is bad news. So let's explore what that means. Based on January economic data and Q4 revisions, the U.S. economy appears to be in a stronger position than economists forecasted. Job growth was robust as employers added 517,000 jobs, well above the average 291,000 jobs added each month in Q4. Consumer spending also exceeded expectations, with retail sales rising over 2% month over month after two consecutive monthly declines to end 2022. And manufacturing output was unchanged after contracting in the previous 2 months. We will need to see confirmation, but it appears increasingly unlikely that a recession will begin in Q1 as predicted by so many economists. Initial jobless claims and continuing claims both continue to trend lower as the labor market proves resilient once again and confirms strong domestic employment. And while inflation has clearly peaked, it still hasn't fully returned to the historic benchmark of 2% targeted by the Fed. This chart from Calculated Risk uses CPI ex shelter to strip out the pandemic-related housing changes to show the continued downward trend in year-over-year inflation, which is great. Yet the past few months also show an annualized increase of 1.3% for the month-over-month inflation figures. Don't stare at that chart for too long, it'll make your head hurt. Just know this means the Fed may feel it needs to ramp up rate hikes from the expected 25 bp increase for the next couple of months. And to this point, a couple of Fed officials recently turned hawkish and are open-minded about whether to increase rates 25 or 50 basis points at the next meeting on March 22nd. Most of the S&P 500 companies have reported their Q4 earnings as of last week, resulting in an average decline of about 5%. Although negative, this is not viewed as disastrous and is largely priced into the current market, as earnings momentum may be fading in the face of persistent macro headwinds, namely the Fed's aggressive rate hikes thus far combined with rising input costs. This again brings us back to the good news is bad news discussion. All of these other data points insist we have a happy, healthy economy. And to a certain respect, that is the case, which gives the Fed latitude for more hikes and a higher terminal rate. Many analysts expected to see cracks in the foundation by now that may lead to a recession within the first couple of quarters this year. Well, it's getting harder to make that argument at this stage. And this chart by Bank of America shows that the fear of a recession over the next 12 months is down sharply. If the peaks are any indication of what's in store for stocks, the worst might be behind us. All things considered, we remain cautiously optimistic that the economy and markets will move in a positive direction this year, though there may be some bumps along the way. As always, we appreciate your trust and confidence to help you navigate these uncertainties.